Okay, so this graph is showing long-run equilibrium. We've got downward sloping aggregate demand. We've got upward sloping short-run aggregate supply, and then long-run aggregate supply as well. This is where real domestic output is. We're at full employment, and it shows the price level. This is somewhat similar to microeconomics. This graph right here is showing a shortage. You'll see that the price level is below the equilibrium price level, and so consumers can't get everything they want, and that's basically consumers are going to bid prices up, which in our market we were seeing prices for housing going up. That's micro, just looking at one industry, but we're looking at overall inventory, and prices are going up, so it'll move to long run over time, or I should say equilibrium over time in this graph. So aggregate demand is less than aggregate supply, so that's a shortage. If our price level was above equilibrium, we would have a surplus, and so that would be when aggregate demand is less than aggregate supply. That would be a surplus. If we had a table with numbers, it would be just like it was in microeconomics. Equilibrium will be where aggregate demand equals aggregate supply at that price level. So that's how you know where equilibrium is. It would show price level, and then aggregate supply and aggregate demand would be the same. That'd be equilibrium. And again, if aggregate supply were greater than aggregate demand, we'd have a surplus. If aggregate demand is greater than aggregate supply, which is what this graph is, we would have a shortage. All right, and this graph is showing a shift in aggregate demand. At aggregate demand 2, we're at long-run equilibrium. We have full employment. We're at price level 2 and output Y2. And then let's say we have a shift to aggregate demand 1, which I think is what's going on right now. Consumer wealth has dropped a lot due to the stock market. Consumer confidence has dropped. Investment spending by businesses has dropped. We will have a government stimulus coming out within the next few days. That's a transfer payment that does count towards aggregate demand when consumers get that money and businesses get that money and they spend it. So it will count, but the transfer payment does not count. Hopefully that sort of makes sense. But anyway, right now I'd say we're aggregate demand 1, AD1, and so that recessionary gap you see at the bottom represents unemployment. So Y2 at the long run aggregate supply curve shows you full employment. Typically 4 to 6% is the full employment rate, but a shift from aggregate demand 2 to aggregate demand 1 would show you a recession, would show you unemployment, due to that change in consumption, spending, investment spending, potentially government spending, and or net exports. This last graph is showing you a shift in short-run aggregate supply. So in this graph, we're shifting aggregate supply to the left. That could be due to decreased productivity. It could be due to an increase in the cost of inputs. We're definitely not seeing an increase in the cost of inputs right now, or that I know of, but we are seeing a decrease with some companies not being able to produce and some supply chain difficulties. But maybe we're seeing some increase in productivity. But this graph shows short-run aggregate supply shifting to the left. In this situation, the price level is going up, and unemployment's also going up. This is also stagflation. So higher unemployment, higher price level definitely is something an economy doesn't want to see. It's a real problem to fix. If we had a graph that showed aggregate supply shifting to the right due to lower costs of input or increased productivity or whatever, we would see increase in employment or decrease in unemployment and a lower price level. So somewhat similar to microeconomics, but you have to remember it's all aggregate. We're looking at the total output, real GDP for the entire country. We're looking at price level, which is related to CPI and inflation, so overall prices. So we're looking at all these different goods and services instead of just one market.